Hey traders, welcome to another video. So in this video, I'm going to show you how I passed 6 50K funding ticks evaluations. This is for futures prop firms. I want to go over my whole risk model here that I use to achieve these passes with the highest probability possible as I'm trading the evaluation. Okay, so if that sounds interesting to you, please watch the whole thing because you will give yourself a huge advantage when you are trading these evaluations. Okay, so let me just show you. I'll hide my screen here for a second, my camera. My evals are right here on the left. You can see funding ticks, you need 5% profit to pass, which is a lot nicer because most of them are 6% for these one-step evals. And before we go and give a breakdown of what this looks like, we'll go over to the home page. I'll turn my screen back on so you can see my beautiful face. There we go. How happy are you now? So let's scroll down here. So this is what I took for funding ticks. It's the Pro Plus 50K eval. Now they have 1 and 0. I'm just going to recommend the Pro Plus. I think that has the best chance long-term for the actual trader to be profitable. So I will leave the link to these guys in my bio too if you want to check them out for yourself. They're super solid though. So they're the owners of Funding Pips, right? The Forex version. But yeah, let's take a look at the profit target. Now that's 2,500, which is 5%. And then they give you 4% drawdown. So you have 4% drawdown and you have 5% to pass. So your odds of just winning blindly are quite a bit higher than your average futures evaluation that requires 6%. And the good thing about these guys too is they have end of day trailing drawdown. I think at this point, you know, it's worth just avoiding equity trailing drawdown at all costs. Most futures prop firms don't even do it anymore, and it just creates really bad trading habits. You're constantly trying to exit the trade before it pulls back, and you're not really learning how to hold profitable trades. So always look for end of day trailing drawdown. Okay. Now, a couple things here. You need 3 minimum trading days at a 40% consistency. You know, I don't really understand why they add that in there because you can't achieve one without the other. So they could literally just delete minimum trading days. Having a 40% consistency, what that means is that your profit on the day can't be more than 40% of the overall profit you need. So if I bring up a calculator, let me just pull one up here for you guys. And I'll bring it over here real quick. Okay, so if we need 2,500, right, we just times that by 0.4. Okay, and that's going to be the maximum amount we can make in a day is 1,000. If you make more than that, then your overall profit is going to have to go up to pass the account. So whenever you're doing your trades, you have to think about this number here when you're trying to pass these. Okay, and the only other thing you need to worry about is contracts. You can't go over 4 contracts. That is for a 50K account, 4 contracts is plenty, okay, unless you're super scalping or something like that. Okay, so let's go over to my dashboard again. We'll do a breakdown here. So I'll pick one of these accounts. Let's pick this one here. And we'll just take a look at what I did to pass, right? So you can see my profit over here is, I started August 28th, ended August 31st. That's 3 days, right? Bang, bang, bang. I made slightly over the required profit. And I just do that is because when you're in a trade and, for example, you're using TradingView or whatever you're using and your take profit is set to 1,000 exactly, well, a lot of the times it'll close at like 900 and $990. So you're $10 short. So I always just go a little bit higher just to account for that slippage or price difference, whatever you want to call it. Let's go down to the, you can see they have a consistency score here, which is really nice on this account. So as long as you're under 40%, you're fine. See, it says my max daily profit on the day was 933. So that's good too. All right, and then this is my trading calendar. So I have to go back to August. You can see August 28th, I took a trade and I made 660 on that trade, okay? And actually, let me pick a different account because this account was actually not the best example of what I normally do. Let me see if I can find a better example. Okay, this is a better example. Check one more here, 1 second. Sometimes the choppy markets will create. Okay, check this one. We can go through all my accounts and see which is the best example here for all you. Okay, this is probably the best example. Okay, so as you can see here on the 28th, I made just over 1,000, right? Which is fine, only $1 over. So that's not a big deal. And then on day number 2, I made 957. Okay, and then on the last day, I don't know why it's reporting on as September 1st. There's a delay. It's because there's a delay here when reporting on the dashboard. $547 on the 3rd day. So we can just think of it as day 1, 2, and 3. Now, here is what I do exactly for my risk. Let me go over to this here. We'll draw on this. Let's pick a drawing space here. Okay, so if we look at the evaluation itself, we need a 40% consistency and $2,500 profit. Okay, so what I do is on day 1, okay, we're calling this day 1. Oh yeah, there we go. I target $1,000. Okay. And I'm going to risk all of my drawdown, all of it. And I'll explain why. And I know you're going to think, oh, this guy's just gambling, but that's what we're doing here. We are setting ourselves up for the best probability to be successful in these evaluations. And the biggest problem I see everyone doing is that they're trying to get cute with these like, oh, I'm just going to risk like 0.5% and I'll go for 1 to 4R or something like that on their evaluations. And you're just going to put yourself in drawdown because you're likely to lose one of your first 2 trades. Very likely. So it's better to run the highest possible win rate as you can. And the way you do that is you target the maximum amount you're allowed to trade per day, and you risk the maximum amount you're allowed to lose per day or per the account. Okay, so the base probability to win this trade right here, targeting at an inverse 2-to-1 risk reward, is around 66%, right? So you have a 66% chance to win this trade just by blindly picking buy or sell on gold. Okay, so I'm just going to go over to an eval here. That was my previous, this is one of the funded accounts. But if I was going to take a trade, let's just say this is an eval at 50K, fresh start, okay? So what I do on gold, let's say I want to go long on gold, right? I'll go long. And let's say we set our stop loss to $5 on gold, okay? Or no, it should be bigger. Let's say $10 on gold for the stop loss and $5 for the take profit, right? 2-to-1 inverse. That's what the trade looks like, right? So basically this is what I do. We can create a limit order. Let's see. So maximum was 4 contracts. Let's see. So 4 contracts we don't want to do. That's double what we can make on the day. So if we go 2 contracts, perfect, right? 2 contracts at this range, $5 take profit on gold, $10 stop loss on gold. That's the perfect range for day 1. Okay, that's something I would do exactly. And then you can always move this down just slightly if you want to make sure the account breaches if it doesn't go in your favor, right? You don't want to like close the trade out with like $10 left on your account. It's just going to be a headache. So that's what you do day 1. Now, you have a good probability to hit this. And I always recommend, like, if you're going to trade, always try to trade with the momentum, because these are a lot tighter trades. You don't want to like get cute and try to time the top of a move. It's a lot better to wait for a little bit of a pullback and trade into with the momentum on the day, just because you're a lot more likely with this huge stop loss buffer. You're a lot more likely to hit that continuation of that momentum rather than time a reversal perfectly. So that's just a little piece of advice I would say when you're taking these inverse risk reward trades. Okay, so if and when you hit day 1, you're going to do the exact same thing day 2. Okay, and as you can see, that's what I did. We hit day 1, right? With our 1,000 profit. I did the exact same thing day 2, hit that. And then day 3 is a little different. So day 3, I will do the same setup. But day 3 is going to look a little different. I'll probably go less contract size. So let's cancel that. So day 3, I'll create a limit order. We did 2 contracts, but I only need 500 to pass the challenge, right? And we don't want to go crazy. Like, we don't want to go crazy high contracts if we're not targeting very much. So doing a cutting that in half and targeting a $5 move still is something I prefer, just because if I did 2 contracts, I'd only need a $2.50 move, and that gets a little bit crazy with the volatility, right? So I think personally it's a better idea. Day 3, cut the contracts in half. Then you can move your stop loss way down here, right? Because of equity trailing drawdown, you still have 2K worth of stop loss. Now that's your trade. The probability of winning this trade is 75% if you're just blindly pressing buy or sell. Okay, so think about that. So if day 1 is 66% chance to win without any strategy, day 2, 66% chance, day 3, 75% chance, you have a very good chance to pass if you're running multiple accounts. That's why, like, I got a bit lucky, but gold was pumping in my favor, passing all 6. But even if I didn't pass all 6, I could expect to likely pass at least half of those 6 just by implementing this risk model. And that's why it's so powerful, because if you're struggling just passing evals, you shouldn't be, because they have such a quick turnover rate when you're doing it right. You just need a little bit of excess capital, but you need that for any industry where you're going to be making money long term. You have to have some money to initially invest, right? In this case, you need money to initially invest into challenges, but you don't want to just throw it down the toilet. You want to run a model that makes sense on a large scale. So your probability is already in your favor when you're trading these evals, and then your payouts pay for all of your failures and then some. Because if you think about this, I think these accounts were, let's go back to here, with the sale, let's just say I paid $100 a month, okay, just to keep it simple. Okay, so let's write that down. I'll go up here. I'll do this. This will be better. $100 times 6. Okay, that's going to be $600. I'm really good at math. Okay, now, if I even pass half of those, which I should with this risk model, you should pass at least, let's just say 4. Let's just play it safe. Let's say I pass 4 running this model, blindly taking trades with that risk model, okay? And the great thing is too, guys, when you trade with this risk model, it goes fast. You either pass fast or fail fast. You don't waste your time. You can start to make money when it works out, right? So let's say I get 4 fundeds. So the good thing about having 4 fundeds is you can run the fundeds exactly the same as you run the evals. And if you run it exactly the same as you do the evals, you're going to end at 2,500, right? You're going to end at 2,500 profit if you pass 4. Okay, so if you pass 4 and only 2 of them you run the same as the eval, so you hit $2,500 just on 2 of those, well, then you have $5,000 profit total, right, on your funded accounts from a $600 investment. Now, you can't withdraw all that because they have a buffer rule, but you can withdraw above the buffer. So you can withdraw 500 on each account, right? So you're going to have a 40% return on your investment, because if you withdraw 2 accounts of 500 each, it's going to be $1,000 profit, right? You've only paid 600 for the initial 6 accounts. Now you have 2 fundeds that have produced a total of 1,000 you can actually withdraw. But the good thing too is you can actually run those accounts again after you withdraw, and the next time around to hit those, the next time around you trade those, you already have a good sized buffer, so you can go for a bigger payout next time if you want, right? And the risk model for funded accounts, you can do a whole bunch of different things, but I'll just write it out exactly what I do. So if I get funded account, day one, I'll do the same thing as I did in the funded. I will target 1,000 and risk 2,000 like that. And day two, exactly the same. Day three, day three, personally, what I would like to do is same. It was just to keep it simple. Same, right? Now, if I hit all those 3 days, right, I have a 66% chance to win each day. If I hit all those 3 days, well, then I can withdraw. Well, honestly, you need 5 trading days, right? So day 4, this is what I would do. I would target 200 and risk 1,000, okay? Something like that. Day 5, same as day 4. Okay, so now we're gonna have $3,400 on the account if we do it like this. And guys, trust me, it looks difficult, but it's not difficult. I've done it many times, right? And it's just a numbers game. And if you have a good entry model, you'll experience the profits like this. And if I have 3,400, and this is exactly what I did with my previous payouts, if I have 3,400, I can withdraw anything above the $2,000 buffer, right? As long as I have my 5 profitable days. So I can literally withdraw 1,400 on each account, right? And that's the first time around. You know what I mean? That's the first time around. You can run it again after. And this is all from a $600 initial investment from 6 accounts. So you can see how it's a numbers game, and if you take advantage of the base probability of having your trades work out because you have a high inverse risk to reward, then that's going to be the key. And just a quick note, like this is for futures evaluations, right? Not for Forex. Forex, I have a risk model. It's completely different. It's a different game, and you can get that in my ebook. I'll leave in the bio. I suggest you read through that. You can't do that on Forex, but you can do it on futures. On futures, it works very well. Futures has a very high and fast turnover rate, but it also has a very fast ROI. So that means if I dump $1,000 into futures evaluations, my return on investment will be quite a bit faster than Forex, $1,000 on Forex, because Forex generally has 2-step models and they have really slow approval processes and all that stuff. So going with futures is nice because you can start making money quickly, and it's not that much different from Forex, right? You just have to get used to it. So yeah, that's the risk model that I use. I just wanted to record that video, kind of show you guys what that looks like on the inside, because it's not complicated. You just have to be consistent. That's all. And if you're consistent, you'll see success long term, especially running risk management models like this that give you as much advantage over the prop firm as possible. That's the name of the game. Okay, so yeah, if you have any questions, always hit me up in my Discord. I'm always in there. Links in the description as well. Hopefully that helps you. And yeah, good luck with your evals. I'll talk to you in a bit. Peace.